Okay, let's just jump right in. We are seeing some serious drama unfold in the markets in real time.
We really are.
For weeks now, I mean, the headlines have just been dominated by this extreme volatility in crypto. Bitcoin is, well, it's basically in free fall.
It's shed nearly a third of its value.
A third of its value from that peak in early October. For anyone trying to figure out where this market is headed, this has to be causing some serious anxiety.
It's more than just anxiety, you know? It's really a profound challenge to investor confidence. And I think our mission for this deep dive is to get past those emotional reactions and really look at what the information is telling us.
Right.
We're going to examine the forces at play here, both the structural glitches and these massive speculative unwinds that are driving the market right now, and maybe connect it back to some of the fragility we've seen before.
And welcome to Everything You Need to Know About Finance. We're diving deep into the recent history and the mechanics behind Bitcoin's really dramatic price slide.
And just a quick reminder for everyone listening, this is an impartial analysis based on the information out there. It's not financial advice.
Absolutely not. And if you do find this kind of content interesting, please like and subscribe. It really helps us out.
It does.
So let's start with the scale of this drop, because I think the speed is what's really terrifying people.
It's the velocity of it.
Exactly. Bitcoin is sitting near, what, $84,476 right now. That is a massive slide from the high of around 126,000 we saw back on October 6th.
Just a few weeks ago.
Just a few weeks. When an asset loses 30% that fast, you know something fundamental is being tested.
Oh, for sure. And the consequences are, well, they're extensive. Bitcoin is actually on track for its worst month since that whole cascade of failures back in June 2022.
I remember that.
And the fear is spreading. The total crypto market cap, it briefly dropped below $3 trillion for the first time since April.
So it's not just a Bitcoin story.
Not at all. This isn't just Bitcoin bleeding. You've got Ether and a lot of the key altcoins. They've all suffered similar, really steep declines. It's a classic risk-off move across the whole digital asset space.
And this wasn't a slow correction, was it? It felt like a really focused, high-speed drop right in November.
It was.
So what triggered it? What was the source of this intense selling pressure, and why now?
Well, the initial push, the real momentum, was driven by something very mechanical.
Okay.
Forced liquidations. When you look at the timeline, analysts point to this crippling bout of liquidations around October 10th.
A crippling?
Yeah, and that one event wiped out a staggering $19 billion in leveraged token bets.
$19 billion. Can you just walk us through that for a second? I mean, we know what a margin call is,
Right.
But how does that sheer scale of liquidation completely destabilize an entire market?
It basically creates a self-fulfilling prophecy, a negative feedback loop. So traders use really high leverage, they're borrowing funds, to make bigger bets. When the price starts to fall, their positions get underwater, and the exchange automatically sells their assets to cover the loan.
Which pushes the price down even more.
Exactly.
Yeah.
And that forces more selling, which then triggers the next layer of liquidations. It just spirals.
And we saw that happen again, right?
We did. After that first $19 billion rout, another $2 billion in leveraged positions were liquidated in just one 24-hour window. So the pressure was just relentless.
So that's the retail side collapsing. But what about the bigger players? We also saw a lot of institutional hesitation, didn't we?
We did, yeah. Institutional participation has definitely weakened. Those U.S.-listed Bitcoin ETFs, they've seen significant net outflows.
So big money is heading for the door.
Or at least staying on the sidelines. JP Morgan actually highlighted this. They suggested the correction was really driven by retail selling of both Bitcoin and Ether ETFs. So it implies that the smaller investors, they got spooked by that initial drop and just ran for the exits, which put all that pressure on the price.
That makes sense. But then you have the really specific high-profile stuff, the whale activity that makes the news. I'm thinking of that crypto wallet, the one labeled Owen Gunden. This person or group held Bitcoin since 2011.
A true pioneer. An OG.
A true OG. And they sold $1.3 billion worth and just recently divested their very last coin.
And that kind of decision from such a long-term holder, it's just hugely symbolic.
It has to be.
It sends this powerful signal to the rest of the market. It basically says that even the people who weathered every other storm are now taking their profits and walking away.
And you combine that psychological hit with the broader market getting shapy.
You have to. You can't separate them. Crypto is still seen by many as the ultimate risk-on asset. So when U.S. stocks, which were flying high on all that AI enthusiasm for companies like NVIDIA, when they started to pull back because of worries about valuations and the economy, well, crypto was always going to take the hardest hit. It's all part of that general risk-off mood.
Okay, so that really explains the selling pressure. You've got the mechanical, the psychological.
Mm-hmm.
But this is where the story gets, I think, really interesting.
Mm-hmm.
Because beyond just, organic selling, there are these competing theories about whether the system itself is actually sound. Is this just a market doing its thing, or did this crash expose, an unfixable flaw in the machine?
And this is where we shift from just market mechanics to systemic risk. The strategist Tom Lee, he was one of the loudest voices on this.
Right.
He was claiming that a mechanical glitch was really central to how fast the price dropped, especially during that big crash on October 10th.
And he linked it to the liquidation system we were just talking about, ADL, right?
Exactly. Auto-deleveraging liquidation. He said there was an automation flaw tied directly to it.
So this ADL system, for those who might not know, how is that different from a normal margin call? And why did its failure have such a huge domino effect?
So ADL is designed to cut leverage and liquidate positions extremely fast, especially when you get these big volatile moves on derivatives exchanges. The failure wasn't really in the ADL system itself.
Yeah.
It was in the pricing feed, the oracle, that it was depending on.
The oracle. So that's the bridge that feeds real-world data, like prices, into the system.
Precisely. And that pricing feed, well, it went rogue.
So what was the actual error? What set the whole thing off?
The glitch was tied to a stablecoin called USD.
Okay.
On one specific exchange, this stablecoin had a severe liquidity problem, and its price just dropped wildly, all the way down to 65 cents.
65 cents. So it lost 35% of its dollar peg.
On that one exchange, yeah. But crucially, the exchange's internal oracle treated that 65-cent price as the correct real value for the stablecoin.
Oh, no. So if the system suddenly thinks a dollar is worth 65 cents, then any collateral tied to that it's instantly liquidated based on totally bogus data.
That's exactly what happened. Because the ADL mechanism trusted that price, it triggered these massive cascading liquidations across accounts that might have been perfectly fine otherwise.
Wow.
Lee said almost 2 million crypto accounts were wiped out in that single event. Some of those accounts were actually profitable just minutes before the oracle fed in that bad data.
So he compared it to the 1987 crash, right? The portfolio insurance issue.
He did. A failure of computerized risk management.
But that raises such a critical question about this whole idea of decentralization. If one technical failure on one exchange, because of one internal oracle pressing one stablecoin wrong, if that can wipe out 2 million accounts globally, how decentralized is the system really?
That's the core conflict, isn't it?
It sounds like the data feed is still a massive single point of failure.
It is. The structural integrity of this supposedly decentralized system is being undermined by these centralized automation and pricing tools. But the controversy, it doesn't even end there with the glitch theory.
Right, because Lee also talked about manipulation.
He did. He publicly aligned himself with that view, too. The idea that this wasn't an accident, that it was a concerted attack.
A theory that powerful players are doing this on purpose.
Yes. The belief is that they're intentionally driving Bitcoin down using futures and derivatives to, in his words, scare people out of their corn.
Scare people out of their corn.
Calling it one of the biggest scams. The motive, obviously, would be to crash the price, force all those liquidations, and then just swoop in and buy up all the assets for cheap.
But not everyone is buying that, are they? What's the other side of the argument from traders and analysts?
Oh, the critics push back hard on both theories. They called the glitch and the manipulation claims conspiracies or just denial.
So what's their explanation?
They argue it's just simple, organic market dynamics. Too many retail investors, as one trader put it, aping in at the top earlier this year, and now that the momentum is reversed, they're all just unwinding those positions.
So in that view, the market just got ahead of itself, and this is just a necessary, even if it's brutal, correction.
Exactly. The classic crypto debate. Technical failure versus intentional malice versus just simple, over-leveraged greed.
All right. Now that we understand the current turbulence, let's step back a bit and talk about the fundamental appeal and the risks of even owning Bitcoin. The pros and cons.
It's fascinating because the foundational elements are in direct conflict with each other.
How so?
Well, on the pro side, you have the original idea. Bitcoin is the first decentralized cryptocurrency. It was built on this free market, anti-central bank ideology back in 2008.
By Satoshi Nakamoto.
Right. And its transactions are maintained on that public ledger, the blockchain, all validated through cryptography, totally outside of government or bank oversight. That trustlessness, that's the core appeal. That's what draws in the true believers.
And then there are the inherent risks. I mean, the volatility we're seeing right now is just one piece of it.
It's the main feature, you could say. This 30% drop is serious, but it's also a reminder that this asset can have these spectacular collapses. You have to look back at 2022.
The Terra USD implosion.
That created a domino effect that brought down huge players, and it all culminated in the complete collapse of the FTX exchange. Bitcoin had its worst month then, just like it's having now.
Right.
So history shows us that when these crypto markets contract, the pain is systemic and it is profound.
And beyond the volatility, you've got the regulatory storm cloud that just seems to hang over the asset constantly.
It really does. Because Bitcoin is pseudonymous. Transactions are public, but tied to these anonymous addresses. Its use in crime has attracted intense regulator attention all over the world.
Which has led to outright bans in some countries.
Several countries, yeah. And just general uncertainty everywhere else. We even saw that attempt at an official government endorsement fail pretty spectacularly.
You're talking about El Salvador.
Exactly. They famously adopted Bitcoin as legal tender in 2021, and by 2025, they had completely revoked that status.
So that whole experiment lasted 4 years.
4 years. And it shows that even these formal state-level adoption attempts are just fraught with instability, which adds directly to the risk for every single investor.
So to kind of pull this all together from the reports, investor uncertainty is just sky high.
It is.
It's driven by this perfect storm of macroeconomic worries, big institutions getting hesitant, and these unresolved structural problems like that ADL glitch that expose some really critical flaws.
The market is just fundamentally vulnerable right now. It's getting hammered by both forced mechanical selling and this underlying technical fragility. The volatility shows the system is kind of operating without a reliable safety net.
And looking at the charts, the technical outlook, it still looks pretty bearish.
Resistance is definitely pronounced. And the analysis suggests the market is facing this continued risk-off sentiment.
I've seen some analysts predicting further declines, with some targets maybe around $80,562, though it seems like there's strong support holding around $75,000.
For now, yeah. The overall feeling is just extremely cautious, especially if those bigger macro concerns get worse through the end of the year.
Which brings us, I guess, to the final provocative thought here. This whole crash has shown that these so-called decentralized systems are still really susceptible to centralized points of failure, like that Oracle glitch. So the really important question for the long-term future of this asset is this. Are these catastrophic structural failures where millions of accounts get wiped out because of bad automation? Are these just isolated incidents? Or do they represent inherent, maybe even unfixable flaws that will always prevent Bitcoin from achieving the kind of global stability you would need to be a widely adopted medium of exchange?
That's a multi-trillion-dollar question, isn't it?
It really is. A question for you to think about as you navigate these very complex and volatile markets. Thank you for joining us for this deep dive.
Thanks for listening.
And make sure to try out our latest episodes for more deep dives into finance, technology, and global affairs.